Me escuchan. So we're going to meet on YouTube from now on. I know I can't hear you speak, but most of the time students don't ask questions verbally. If you want to speak to me verbally, you can call me. You have my number. I can put you on the air. The main reason I chose YouTube for streaming is for the translator, but something's happened and YouTube has stopped translating videos automatically. So I have to figure out how to fix that. But in the meantime, I'm going to post the videos here. And once I fix it, I will translate the videos. But for now, you should be able to see the captions in English as I'm speaking, if that helps. That's good enough for now. So I'm going to pick up where we left off last class. Does anybody have any questions? We're also going to wait for any students who are planning to attend. Okay, I see you chatting there. Okay. All right. Any comments, questions? You want to call me? You want to text me? If you call me, I'll put you on the microphone. No comments, questions? What's the video? Okay. So if you see the video turn blurry, you need to reload the video, all right? Because I'm not sure why that happens, but that will fix it. Okay, so I'm not sure why that happens. Let me make sure. Oh, you guys aren't seeing my, not seeing my iPad. Not sure why. All right, so it's 5 minutes after. Okay, we got 10 people. What I have to do. Okay, so what have you guys accomplished? Were you able to get the text, read the chapter, get the calculator? You got all the resources in place? Comments? All right, well, I'm going to continue with where I left off. I will upload the video from last week to Moodle so it's all in one place. There is a little bit of delay in this video, so when I ask questions and you comment, there's like going to be a delay, and then when I respond to your comment, there's going to be a delay. So that's the only downside. But this is a very powerful. I think this is the best way to broadcast and record and store videos. All right, that's why we're here. All right, so we left off here where I was talking about cash flows. that had a certain pattern. And so the example that we discussed was this one. It was very surprising, I think, for most people who didn't realize this, that a constant sum forever to be received, a constant dollar sum to be received, will actually converge to a value. And I explained last class that this is because as time goes on, eventually, due to the time value of money, what you're really adding in present value terms diminishes all the way to zero. So eventually you're just adding zeros to your calculation of the present value, and it becomes 2,000 before that happens, a nice round number in this example. So this is known as the perpetuity formula because these cash flows occur in perpetuity. Now there's certain characteristics here that need to be in place, the criteria need to be in place to be able to use this formula. All right. Oh, you can't see my video still. I'm not sure why. Okay, there we go. All right, so this is the formula. And what were those criteria? First of all, the cash flows are level. They're the same amount. So the same amount, and those cash flows are forever. And something really important, they're all called C1. Why are they all called C1? I think I lost you. Okay, very good. So they're called C1 because I'm looking at text to see if you're commenting there. They're called C1 because the first cash flow occurs one period from now. So it takes the subscripts according to the timing, right? So the first cash flow of the series occurs one period from today, or from one period from when you want to value it. Okay, remember we want to value it here. Okay, are there any other characteristics we need? Cash flows are level, infinite cash flows, the first cash flow one period from today. And if those are the case, this is the formula that known as the perpetuity, which will calculate that for you. Right? So that's where we left off. How about this problem? What's different here? It has growth. Very good. It has growth. Yes, it's compounding. The other one was compounding too. But this one, yes, has growth rate. Yeah, like I can see what you mean. Like it's a compound here. So this is the growth in it, right? So when we read this, ABC Incorporated, this is a company, corporation in particular, that just announced it plans to grow steadily and will pay stockholders $100 per year per share starting next year, and then 2% more each year indefinitely, giving a required rate of return of 5%. What is the fair price of a share of stock? Okay, so what did we learn? What do you know about stock? What do you know about corporations? I think I need to move this a little. Corporations are companies, and a lot of that we do here we can carry to non-corporate forms of business or companies. But the particular thing about corporations, and there's two things. So corporations are not necessarily owned by the people who run it. Okay, so it could be that the managers have stock in the company, like a share in the residual profits, we say, of the company, because after the corporation makes revenues, they have to remove expenses, and they have to pay any outstanding debt before they consider that they have profit. And then from those profits, they decide if they're going to distribute them to shareholders or if they're going to retain them and reinvest them in the company. So those payments to stockholders will be determined how many or what percentage of shares the stockholders hold. If you have one share and there's 100 stocks, then you have 1%, right? Claim or residual claim. That in itself is important, okay, that they pay these amounts that are called dividends. They pay dividends to their stockholders, or they retain the earnings and reinvest them in the company. And this ownership, the interesting thing about this ownership is that it doesn't depend on the lifetime of the owners. Like usually if a company is run, like a company is started by an individual, and then that individual remains running that company through his lifetime. When the individual dies as the expert, he might try and pass it on, but it won't be viable, right? Because that person had all the knowledge, and it's hard to pass that on unless he educates, maybe he has a protege, someone who brings along, and he shares everything with him, right? Or her. And then he passes all that and information on, and the company survives. Well, the corporate form of business, the owners and the people who run it are different, could be different people. And that way the ownership can also, because its ownership is in a stock, ownership is in stock form, that stock can be sold, or it can be traded, it can be passed on. So if you're looking at a corporation, stockholders could bequeath, right? They can pass down an inheritance to their children or to other people, the ownership in that firm. So in this way, the lifetime of the owners doesn't necessarily restrain or limit the life of the corporation. So because of that, notice we can assume that those cash flows are forever. Now you'll notice if you've read the chapter, the first chapter, you'll notice I want you to read through it, at the very least skim through it, and then I'll highlight the important points. What we're going to use the textbook for, I think I mentioned it before, is mostly for reference, right? But you should read it. You should read through it. And okay, so stockholders, there's also creditors or bondholders who invest in the firm by loaning money to the firm. They're first claimants, on the profits of the firm because they have a guaranteed return that we'll talk about once we get through these simplification formulas. But for now, we have this setting where this company announces that it's going to grow, and now this information is going to be absorbed by investors, right? They're going to use this information to price the stock, and that's what you're going to do right here. So you're going to use this information. You're going to assume the firm exists forever. However, corporate forms of business don't necessarily, right? Many of them last on average about 40, 50 years. Some of them longer. They may change by merging into other companies. And so remnants of them still exist, but having said all that, we're still going to assume these returns are forever. Okay, so it's going to be $100 per year per share starting next year. Very good. And then 2% more each year indefinitely. So which of these is the interest rate? There's two percentages in this statement. Which of these is the interest rate? Alejandro, you mentioned required rate of return, right? That when I asked the question about what's different. Well, I'm not sure if you remember, but we are going to see an interest rate in most of our problems. However, depending on the context, a different term is used to refer to what we're going to use as the interest rate in our formulas. If this is buffering, I apologize. Not sure what's going on, but we'll see. Okay, you're back. All right, so the required rate of return in this problem is the interest rate. Very good for those who knew that. And it's 5%. And the growth rate, this is going to be called G, where this one is going to be called I. Okay. So what this looks like is the first cash flow will be 100, the second cash flow will be 102, and the third cash flow will be, if you do the math, I think it is $104.04. Knew that, but I had to check. So it goes up, right? But it's not just higher, it's higher by a factor of 1.02. It's a 2% growth rate. Because of this pattern, we can notice here criteria. We can still use the same formula but modify it slightly. Okay, even if we have two different, we can modify the formula slightly and get the right answer. So in this case, our cash flows are not level, they're not the same, but they are related by growth rate. So the formula is going to be changed as we see each cash flow will be, from a present value perspective, you're getting less than 100. However, it's a slower erosion of the cash flows when compared to the last example without growth. I don't know why I'm buffering. When I buffer, what happens is I lose the chat, and I don't know exactly why. So we're going to lose the chat, unfortunately. But let's just enjoy it for now. I wonder if I can save it. I'll try and save it before we get off. These little technicalities. Not sure what's happening. Okay, so what we see are the cash flow erosion due to the time value of money is slowed by the fact that the cash flows grow at a rate of G. So I could prove this to you, and I'm going to prove all the other formulas I show you. I'm going to prove them from first principles, but this very first one, I'm going to promise you that you've learned about simplification formulas for series in high school, preparatory courses in mathematics. And the fact is that this will simplify to this formula, okay? So this stream of cash flows that looks like this, C1 plus C times 1 plus G, and then growing. This summarizes to this formula, which looks like the perpetuity formula, though with an adjustment. So what does this effectively do? If we divide by a lower number, we're going to offset, because the cash flows are growing, it's going to offset the erosion caused by the time value of money, okay? Effect. So remembering $1 today, so this is how you can remember this. So $1 today is worth more than $1 next period. That encapsulates what we are talking about when we talk about this, when I refer to the time value of money, right? It's more valuable to have $1 today. And we use I as the opportunity cost, or the price of trading off money today for money tomorrow. All right, so this is the formula. Notice that I have a caveat. I have this extra information. Why is that there? Well, the formula, if you have I greater than G, you'll be dividing by a negative number. Sorry, if you don't have I greater than G, you'll be dividing by a negative number, and that doesn't make sense, right? So that's not going to make sense. So we're not going to have a negative present value, even though when we talk about cash flows having to be negative to put in our calculator, that's a different thing. We shouldn't have a negative price. That won't make any sense. So this formula only applies provided that you have a positive number, or I greater than G. Now, having said that, what would happen if I was not greater than G? Let's go back and look at this. So here we see that, let me compare it to this one here. So this was from where there was no growth. This erodes much quicker. Right, so this erodes much more quickly, but with growth, it offsets that erosion, and the numbers, the value being worse from the perspective of today, lower from the perspective of today. So if this number 1.02 was greater than 1.05, what would happen is that you won't eventually hit 0. In fact, the values the values would not converge so that you wouldn't have a whole number. It's likely that, I'm not going to prove this, but PV0 will be like infinity. Okay, it'll blow up. So it won't converge. And so that's why we don't talk about that case, because it doesn't make any sense. Wouldn't happen. All right, so let's solve the problem. And then we'll summarize the criteria for this. Noticing first cash flows 1 period from today, and then growth kicks in. Okay, you have to see the pattern. So plugging everything in, you see, of course, this is going to be a larger number because the growth offset resulted in a price that's larger than originally. With the console bond example, it was only $2,000. Now it's $3,333. So let's take these criteria from this example, or sorry, from this formula, really. Put them here. Now, how do we change them? How do we modify these? Cash flows, so it's not that they are level, it's that they, I'll just call them cash flows, grow at a constant rate G. They are infinite. First cash flow occurs 1 period from today. And I'm going to add one more. Growth occurs or begins in period 2. That. Let me spell that again. Any comments? Just checking my text. If you're going to send me WhatsApp, I'm not going to see it right away. All right. Okay, so let's plug that in here. Notice what I do is just use my calculator and simplify the denominator before I plug it in to get this number. So these formulas are called simplifications. You don't have to use the large NPV formula or the CF or cash flow worksheet on your calculator. They're very simple formulas, but you need to know when you can apply them and when you can't. I have to bring it down. I'm sure how to fix this. All right, so to sum it up, there are no special keys on the calculator to compute these amounts for perpetual cash flows, right? And in general, when you're trying to, when you can't use the formulas as they are because one of the criteria are not satisfied, then you can use the mixed cash flows formula. Obviously, for the infinite cash flows, you can. And I'm going to show you how we deal with that, all right? So all right. So we have a different kind of problem here. So how is this one different than the others we've talked about? No comments? How is this different? I have to leave the F5 button. No comments. All right, so, okay, very good. Yes, Sabrina, it's finite. That's right. It's finite, so it stops. Right, so it looks like a perpetuity, but it's not because they're not infinite cash flows. Now, how will this change things? I'm going to derive a new formula and watch how I do that, right? In this problem, we're actually talking about a loan. Our interest rate is the monthly interest rate. Now, when you see problems in general, so this, I'm giving you very simple problems right now that are going to become more complex. But what you have to do in all these types of, these are problems of valuation. First, identify. So this will be your like your tether, I guess. This is what's going to hold things together, okay? Is that you have to identify the timing of the payments. And convert all variables to the same frequency. And I'm going to repeat this again and again. Again, if also if you see the screen is blurry, just reload. I have to reload. I'm watching myself at the same time to see if there's any glitches in the transmission. Okay, so you need to identify the timing of payments and convert all variables to the same frequency. I will repeat that many times, but you should write it down just as many times to remind yourself. So here it's monthly payments, so we need a monthly rate. So I've taken care of it for you here. And it's going to be for 4 years. So I had to convert 4 years into 48 months. So I followed the instructions. So what formula can I use for that? The formula that I will use is called an annuity formula. Okay, this is known as an annuity. Annuity is a lump sum amount that gets either you can pay a lump sum to later receive cash flows And there'll be an underlying rate that helps that lump sum grow while you're withdrawing from it. So that's something like a pension, right, or a fund that you've paid into and you want to draw from over a period of time. The other way is that that's what's happening here, right? So this person actually didn't pay into it, but borrowed up front this amount that we're going to calculate, and then they have to return it and pay interest over time. So both of those are called annuities. All right, so I'm going to derive the formula, and hopefully you're going to see this many times, so you're just going to have to learn it. Bear with me as I walk you through this. So this is simply the basic perpetuity formula that we talked about already, and this is the timeline corresponding to this formula, right? And I'm calling it part A, and you're going to see why, because this is not exactly our set of cash flows. Our set of cash flows exclude everything after T, the duration of the investment. So we need to lop it off. We need to subtract that, those cash flows. Now, what are those cash flows? It's like a perpetuity and a perpetuity, right? So this is the perpetuity that we're going to take off, and here's its formula, but its time, it's going to be valued at time T, one period before that next payment. So this is not in the right time to be able to subtract off this amount. So what I'm going to do is use the basic time value of money formula and discount it. See that discount factor to the power T? So now this I will call part B, and I can take part A, subtract part B, and get my formula. Now, I'll never expect you to repeat this, but if you guys can take some time to understand this, you're going to save yourself a lot of trouble, because in fact, you might need to use techniques like this in solving some problems. So this is my subtraction. Now I'm going to collect my terms, and what do I see? I see the perpetuity formula here with an adjustment factor, and this is taking off, right? Subtracting off. It's using the perpetuity and subtracting off the discounted perpetuity of all those cash flows in the future that I'm not going to pay, or yeah, thank goodness I don't have to pay them, right? So this is the annuity. Now, before we use it, and this one actually is in your calculator, so we're going to use this. Algebraically, we're going to use it, or manually, we're going to enter it, and then we're also going to use the time value of money keys to enter it. So let's get our criteria list, which was, let's get this one over here. Let's get the list of criteria and see that it's very similar to this. All right, so I'm going to paste it. Oh. No, I didn't want to do that. All right, so those are the criteria. Move it up here. So let's see, cash flows are level, yes. Infinite cash flows, no. So finite cash flows, change that word. And first cash flow occurs one period from today, yes. Okay, so it looks like all we changed was the second one, and that effectively created this adjustment factor here. All right, and I need to move this slightly up, it looks like. Can't see. Questions, comments? Okay. All right, so, sorry there. Let's plug it in. So to plug this in our calculator, and for the purposes of tests, first of all, let me say, all I expect you to do is write this, okay? You write this down. You show me the formula with the values inside. Do not write out the formula again because there are no points for this. Okay, but you have to have the formula with the numbers inside to demonstrate that what's going on. So let's put this in our calculator without the TVM keys. And what I'll do is I begin down here. Now I'm teaching you this because there are some formula that are not programmed, longer formulas that with this pattern that are not programmed in your calculator. So you need to know how to punch them in. So it helps make you familiar with the concepts as well, okay? The principles and where this formula came from. So we're going to begin on with the denominator, and then I'm going to invert the value. I'm going to make it a 1 and add it to 1 so I get this whole adjustment factor, and then I multiply by 100 and divide by 0.01. So I'm going to do that. I'm going to do 1.01 to the power of 48 equals, I'm going to use this key to invert it, right? So I'm going to invert it. Which one was which? So let's do it again. 1.01 to the power 48 equals, and I invert it, and then I subtract or make it a negative by using this key here, and I add 1. Now that's inside the square brackets, and so now I have to multiply by 100 and divide by 0.01. Do you want me to do it again? All right, so let me see the chat. Sandra wants to go back here. Okay, good. Okay, very good. All right, so so I punched it in. I'll do it again. And then we're going to use the time value of money keys. Right? So 1.01 to the power of 48 equals, and then I invert it, make it a negative and add 1. And then I multiply by 100 and divide by 0.01. And there it is. light flashing on and off. Oh, I guess it's my calculator. Okay, so we got that. It's the screen that's creating light. All right, so now let's use so this is the price. This is the price of that loan, or in other words, this is what you pay for that loan. This is what you borrow and then pay back. Okay, that's the way I can say it so many different ways. So here are the steps for the time value of money keys on your calculator. You're going to use the same time value of money row, working from left to right. This is what you enter. Notice the negative payment, and I overwrite face value or future value, put a 0 in there. And this is the amount I get. So in a test situation, I want to see this and this. You get no points for showing me what you put on your calculator. But I do want you to use your calculator. All right, so you're going to show me the formula that you understand what's hidden behind punching these in and their result. So together, 48 periods, interest rate as 1%. Payments are 100 negative because I make those payments. Those are expenditures. Overwrite with the face value of, or future value of 0. You'll find out that those mean the same thing, or we're going to use them interchangeably. And then I ask to compute PV, and I get the same answer. And it's a positive because that's what I receive for the loan. Okay. We're almost at an hour. At 7, we'll take a break. Okay. So let's go back while you're plugging that in. Let's look at this formula together. It's just like the time value of money formula where I had 4 variables. And if I had the 3 values of the variables, I could solve for the 4th one in any of the 4, as long as I had the other 3. So it's the same thing here. I can solve for the value of the loan. If I knew how much I was going to borrow or needed to borrow, and I knew the interest rate on the loan, and I knew the duration of the loan, I could also solve for the payment. Okay. If I knew the payment and the present value, but I wanted to know how long it takes to pay back, I can do that as well, as long as I know the interest rate. So these formulas can be used to solve different variables. And we're going to do that using the time value of money keys or our finance calculator, but you should be able to do it algebraically as well. In other words, you should be able to isolate for the other 3 variables. All right, so did I put the conditions down? Yes, I put the conditions down. So we have another variation on this that's very practical. What about if you have a mortgage or you pay rent? Well, mortgage is more painful. Well, let's talk about mortgage. So you're going to make your mortgage payment not at the end of every month. You're going to make it at the beginning of the month, right? So because you're making it at the beginning, we can't use this formula. I haven't even written it as a criteria, but in general, the default is payments are at the end of the period. The default assumption in these formulas is that the payments occur at the end. Payments occur at the end of the period. The only time you think different is when you're told, or someone talks about a mortgage, or what's called an annuity in advance. You pay in advance. All right. Otherwise, you just assume, and I notice, like I say, I didn't put it in the criteria. We assume the payments are at the end of the period. When they're not, we need a different formula. Okay. And we need to state it explicitly. That's this case here. Here's my example. And then I'll go back to the other pages. And I'll read through this one. You sign a 5-year lease to rent your office space to a dentist for $1,200 per month to be received at the beginning of every month for 5 years. The effective monthly interest rate you agreed to is 1%. What is the deal worth to you today? So basically, you're trying to figure out the value of your office space. Okay, so this is the deal. These are the terms here. So what would you do with this? Well, you figure it, if you wanted to know the value of your office space, to maybe do something else with it, right? So you're going to figure out what's the value. This is the market value. This is what I could rent it for. So you're going to figure out, the value of your space. Maybe you just want to sell it, right? After all. So if someone offers you for more than this amount, you might be enticed to go for it. So, but at minimum, they'd have to offer you the present value of these cash flows here. Okay, so what's different here than in the problem that we just solved is that the first cash flow does not occur one period from now. It occurs now, okay? So it occurs upfront or in advance because it's at the beginning of every month, and then continues for 60 payments in total, but it ends on the 59th month. So how do we deal with this? Can we use the other formula? So what were the criteria? Let's go back to our criteria for the annuity. Take it with us. And I promise you I will derive it. Okay, I'm putting them down on the previous page, but let's talk about this a moment. What if I use the annuity formula with 59 payments, because that will take care of these, right? It'll follow the same pattern that I'm used to, where the first cash flow occurs one period from now. They're all the same, and then they stop when the payments end. But if I just use these, then it's 59 payments, and I have to add in the last one. Since its value is at time 0, I can just add it in. And that's really the formula in the box here. That's it right there. So this is the annuity formula with one less payment. And then you add in that first one. Notice you still use C1, even though the first cash flow is 0, to make the point that it looks just like the annuity formula. All right, so try to relate them to each other so that you don't think there's so many formulas. So it's just really two, the perpetuity and the basic time value of money formula. That's really all we're doing here. All I keep repeatedly doing. Those two formulas create these other ones. And if you know how they're connected, it's all much more easy. So here is the derivation of that formula mathematically, remembering that the first cash flow is here in this box, but otherwise it pretty much looks like the perpetuity formula here. So if I shouldn't put a box around this because that is all of this that's not in the box. So it's funny that I did that, but anyway, think I was just trying to separate and emphasize. But okay, so that's this box. It's all this here after the first cash flow. And I need to remove, starting at T, those cash flows that precede. So that's going to be priced here. One period, remember it was 59 was the last one. So it's one period before the total number of payments. So then I need to take those off. So it looks very similar to what I did before. So it looks like the other formula, and I'm just going to add this C1 in. And that's what I do. I subtract these two and I get this again, the perpetuity with an adjustment factor, removing those payments that I don't have to make, and then I add in the first one that occurs here. So you could argue I could call these all C0, but I'm really trying to make it look like the other formula, that the only thing that you're changing is adding this and adding this when the payments start now. And now this is a very practical formula because a lot of payments are made up front. Okay, this is very practical. Let's see, do you have any questions for me? All right, so let's plug this in. This is what it would look like if you wrote it as like an NPV type question or a mixed cash flows type, in a mixed cash flows appearance. But don't forget, it's at one less. This would be 59 here. So this is the what I call the annuity due formula. And for a total of 60 payments. I kind of repeat myself here. So punch this in, practice punching it in to make sure you can get the answer I get. The answer that you should get is, so I'm going to teach you how to do this three ways. One, let's just punch it in the calculator. Right, let's just put in 1.01 to the power 59, invert it, make it a negative plus 1 equals times 1200 divided by 0.01. And then add 1200. Okay, so this is what you should get. Let me know who gets it. Or maybe, you know what? I'll just let you guys tell me what it is. Somebody's got to calculate it. Close. Louise, that's not it though. Try again. Yes. Sabrina. Yes, that's what I got. Very good. Yeah. Okay, so the value is 54485.51. All right, so 54,485 and 51 cents. If you didn't get that, you guys can practice that. But let's try also to put that into the, a moment, please. I have a noise. Okay, let's try and put that in the time value of money keys. Also try and calculate it manually. Let's have a 5-minute break. Okay. Be back in a bit. Okay, I see some of you got it now. I don't know if I repeated myself. Microphone's on. My video should be on. Okay, let's put these values in the calculator. Now, how are we going to put it in? We're going to put it in as the same way that we entered it, like an annuity with 59 payments. Note that if I put in the 1200 to be received, then I get a negative for the PV. So I need to make that a positive before I add it, right? So you need to turn that into a positive before you add it in to add it up with 1200. So let's do that. So 59 payments. Interest is, we say 1% again. Okay. It's 1%. And then the payments are 1200 to be received. Overwrite future value and compute PV. Make it a positive and then add in the first 1200 to get the answer. So that I call method 1, using the annuity with 59 payments and adding in the first one. But in fact, you can use the calculator with 60 payments, but you have to tell the calculator that this is an annuity in advance. And the way that you do that is you turn on the begin mode of the calculator. Now notice this key here, I'm flashing it, as a BGN. We need to activate BGN. The way you do that is second, begin, second, set. That'll activate begin. And then you can put in the values. Notice at the top you have BGN. And the BGN is indicating that you're in begin mode. So in begin mode, you enter as though you have 60 payments, interest rate of 1. The payments are 1200, and you overwrite face value or future value and compute PV. And you got the answer right away. The only catch is you have to remember to return your calculator to end mode. You just repeat what you did to put it in begin to turn it back. So you do second, begin, second, set, and now the BGN at the top is gone. So let's see. In the notes, I mentioned method 2, and those are the steps there. So try that one. Okay, how's it going? So don't forget when you're done to put your calculator back into end mode. notice I use the same version of the formula because that's the formula. Okay, that's the formula that we're going to use for annuity due. Okay, let's go to the next one. Here, here's the formula. Here's the formula seen another way. Okay, so this is a variation on the formula. Here's the timeline that we saw before, but I'm going to add 1 year back. I'm going to see this, remembering our criteria. To use the annuity formula, we need to be seeing the first cash flow 1 period from now. So why don't I just put in 60 payments into my calculator? What's going to go wrong? Well, what you're going to do is actually find PV, present value minus 1. So what you would get is the value here, but the question asks to find the PV, the present value at time 0. So to get that, you need to make an adjustment. What is the adjustment? You need to accumulate that lump sum amount 1 period. So this is the second way we can write an annuity due formula, making it 60 payments but then adjusting, because that would put you, because the assumption is, remember, the first payment is 1 period from the valuation. So it's thinking you're here, right? You've used the formula to find this. So you need to adjust that lump sum 1 period, accumulate 1 period to put you at time 0. So you have now 2 variations of the formula. I call this last one method 3. And you can use whichever one you want, all right? Whichever one you like. 1, 2, or 3. If you want to manually add it up, if you want to use the time value of money keys with 60 and begin mode, or if you want to use the time value of money keys with 60 in end mode, then you just have to make this adjustment. So why don't you try that and see if you get the same answer yet again. Okay. Any comments? Questions? Sorry, you didn't hear anything I had to say there, did you? Sorry. So I've been kind of talking to myself. So what I was saying is I'm going to post these notes, so don't worry about writing them all out. If you don't have a copy already, I'm going to be posting them in the platform. If you don't already see them, I'm going to open them up. And then there's also a series of exercises for practice. So you can practice annuities. So for now, we've looked at basic time value of money, perpetuities, and annuities. Right? So that includes valuations of stock, includes mortgages, includes loans, and we talked briefly about the consul bond, which was a bond loan to the government that pays bondholders a constant amount forever. What about bonds in general? So bonds can be issued by governments, they can be issued by corporations, right? And there are some features of bonds that you need to learn, understand, but essentially it's a loan. And as I mentioned to you, in the corporate form of business, and even in municipal bonds, Puerto Rico had municipal bonds that they issue, or have municipal bonds that they issue, and the Constitution guarantees payment to creditors, people who've loaned money to the government, and they're supposed to pay creditors before they make any other payments. Yeah, the exercises should be in Moodle. Everything should be in Moodle. I just have to open it up. I think I put everything there, but I think it's still blocked. Like not visible. And so yeah, I'm just going to introduce these concepts, and essentially bondholders have a claim for corporations to profits before stockholders do, right? So it's very important that we learn about features of bonds and valuing bonds. Now, bonds can be initially issued, and then they can be sold, right? They can be sold and exchanged and traded. So at the outset, bonds are valued with this type of information. So here's a bond known as a pure discount bond. Okay, so there's zero coupons. In other words, coupons, we'll talk about coupons. Coupons are payments in the interim. So if you think about the pure discount bond is a loan that gets paid back. A bond with coupons is a loan that is slowly paid back, and if it's not completely paid back, then there's a lump sum at the end. The way it works, a lump sum will be, the way that we're going to do this is that this is called actually the face value. So now this is why I was referring to FV as face value. Okay, so the bond will have the lump sum face value payment at the end, and usually it's $1,000 or $5,000. And in this class, I use 1,000 most of the time, which is pretty standard. And here are the features of it. So it pays 1,000 in 5 years, and you're told that bonds of comparable risk have a yield to maturity of 6%. So this will be our interest rate in our formula, where this is just a basic time value of money valuation, right? Because it's just a payment out here 5 years from now. And this is the interest rate. But we're told about bonds of comparable risk. Well, there is some risk, right? So this is the thing we have to discuss. And bonds are government bonds are backed by the Treasury, right? So those are less risky. But corporate bonds, I mean, if something happens to the corporation, they can't pay you. Okay, now we can also talk about the case of Puerto Rico, which turned out to be risky municipal bonds that creditors purchased, and they're only going to get a portion, the ones still holding that debt, they get a portion of their promised return. So in this case, in general, though, governments with sovereignty back their bonds, their borrowing with the Treasury. So they'll have to just raise taxes to raise money to pay the bondholders back. That's how it's supposed to work. Corporations, on the other hand, could be more risky to invest or to lend to, because something might happen, that they might go bankrupt, they might be in trouble, they might be in financial distress, and they may default on a payment. So that's why we talk about, we refer to the risk here. This is not guaranteed, so I start introducing more realism into these problems. In fact, we aren't all the way there. I'm just going to introduce these features, and then you'll see when we get to talking about interest rate conversions, greater realism in valuing bonds, and I can show you how bonds are listed for trade. So, okay, so what we have is what's called the face value of the bond. This is called the face value. And this is called the time to maturity, or the duration of the investment. And we're going to call this a year. We're going to use it, for 1,000. So we know that here we can use our TVM keys to find that the price is $747.26. So it's a discount, right? It's like saying, well, you get $1,000 in 5 years for $747.26. And in there, you're capturing a 6% rate of return, which is something that could be attractive if relative to the other possible returns you can get, like on a savings account. You're not going to get 6% right now on a savings account, not in a checking account at all. Okay, so you might do that, right? You might do that. We're going to talk about inflation later. I think I promised that we're going to do that too. And right now we're just working with interest. Okay, so make sure you can get this number. Let me know if you don't. All right. All right, so I'm assuming you got the answer. All right, so let's look here now. Let's talk about a coupon bond. So, you know what coupons are, right? It's like you cut those out of magazines, or Walgreens gives you coupons, and those offer you money, really, right? When you buy something, you get a discount for that. Well, these these indentures, these contracts for bonds, would have a coupon that you could cut out, clip, and then turn in to get your payment. That's how the name comes out to be coupon. These are scheduled payments at certain time, and here's an example. A 6% coupon bond pays $1,000 in 5 years, so that's what you see here. And you're told if bonds of comparable risk have a yield to maturity of 6%, what is the fair price for this bond? Again, this whole idea about the comparable risk, so you'll look at the industry and you'll look at if this is a corporation who's offering this, this bond, or if this is in secondary markets where this bond is for sale, you look at the industry and how firms are doing, and you get a sense about what their bonds are being issued for. So, what are the competitors either offering, or what are people willing to pay for debt on the secondary markets? I'm referring to bonds as debt. So to find the fair price now, we're told about this 6% coupon. What's this refer to? Well, the coupon rate is 0.06. To calculate what you get for that, you use this formula here. Okay, the payment is just, you take the face value and you multiply it by the rate. So it's $60 every period, including the last one. So what is the price of this bond? What's the value? What's the most you're willing to pay for this? In fact, this is an annuity plus $1,000 in 5 years. So you just use the basic time value of money formula. I'm just going to say which formulas. You're going to have two formulas. The annuity and the basic TVM formula. You have to add together, right? You're going to have the annuity formula with $60 for 5 periods. What is the rate of the annuity? Do you know? This $60, 60% or the $60 comes from the coupon rate, but it turns out that the yield to maturity, which we'll treat as the interest rate, is also the same number. That's going to make a difference. That's going to have a significant, that's going to give us a special result, or this is a special case, right? So what this is showing is that I 6% yield on a bond means you should be getting 6% each period, but we already are getting that, right? We're getting $60 and $60 and $60. This is paying our interest. This is paying us, and then we're going to have the $1,000 at the end. So what are we willing to pay for that? So I'm not even doing formulas right now. We're going to do that. But what should I be ready to pay for that? You following me? You can call me, you can text me if you're shy. No idea? Well, if I'm getting my interest payments, then I should be willing to pay. Okay, let's just do the math. And then, and then we'll talk about it. All right, so it's an annuity plus the basic time value of money, or let's just put it in our calculator. So I'm going to start with the financial calculator TVM row. Now, this for coupon bonds is where we use all the keys in the TVM row. We're going to start with 5 periods. The interest rate is 6. Remember, we put that in there. The payment is 60. And the face value is going to be 1,000. Now, because the payment and the face value are to be received, those go in as positives. And let's compute the present value or the price. No one's taking a stab at what it should be. And there's the price, 1,000. So essentially, you don't need a discount on the $1,000 to capture the 6% return because you're getting the 6% return each month with the coupon payment. So you're giving $1,000 and you're going to get $1,000 at the end. But in the meantime, you're getting $60 in interest payments all along. So that is the base case. And then we have to think about what if the coupons are lower? What if the coupons are higher in the valuation? We'll talk about that. So let's first go back. So make sure you can punch that in. I'll do it one more time. So it was 5 years. Interest was 6. Payment is $60. The face value is the 1,000 to be received at the end. So you compute PV and it's 1,000. So here is the coupon bond formula. Notice I have both the annuity plus the basic TVM formula. Get my result. Now you can punch that in manually. You can use the financial calculator and you will get 1,000. This is called a par value bond. So if you hear that a bond is at par, it means that you're paying the face value for it. And you're getting coupons of the yield or the interest payments. You're getting the interest payments as coupons. Okay, any questions? Nope. Right. That's what we just did. So what I want to see on your test What's this? You write the formula with the values inside and the result. You should write that too. B0. Okay, so what if the coupon is less than the yield? So if the coupon rate is less than the yield, it'll look something like this. So here's an example with 3% coupon bond. In other words, $30 every period plus $1,000 at the end. What's that going to be worth? Is it going to be worth more than 1,000 or less than 1,000? So you have to think, how did we do it last time? We said that the $60 paid off the interest, so I didn't need to have any discount. Right? But here, I'm not getting the interest. It's 6% maturity, but I'm short on interest. So this is actually going to be worth more than 1,000 to compensate me because I'm not getting the I'm not getting the 6% all the way through. So I need to be compensated at the end. Aha, so now you're getting the hang of it, Luis. Those are great. This is what the financial calculator is for. Really, to make a complex problem very simple. So you got it. Oh, I did it backwards. See, what did I just say? It's worth less because you're not getting enough. I have to edit this video now. All right, so hold on. Go back and correct my mistake. Oh, because I changed pages. All right, so let me correct this and restate what I was saying. All right, so you're not getting your interest payments. So because you're not getting your interest payments, you need to be compensated. And the way you're compensated is you're given a discount. I believe. So my question was, is it worth more than 1,000? Or less than 1,000? You need to be compensated for the fact that you don't get the $60 a month. So it's worth less. You get a discount as an incentive. All right, so this is called a discount bond. Enter this into your calculator as we discussed from left to right. 5 years, 6% yield. Payment is 30. The face value is 1,000. And there's your price. Very good, Hilito. Okay. Now we're going to see what would be the price if you get more than $60 every payment. In that case, let everyone try this first. Let me know you're finished. I can move on. All done? Okay. So here is the example with $70 at 6% yield, $70 each period, $1,000 at the end. The coupon would be $70 because it's 7%. And we expect that because this is more than 6%, we should pay a premium for that. So this is called a premium bond. Okay, you guys tell me what the price is. Very good, Louise. You have to write out the whole formula, the answer, PV0, and I'll be happy. These are the keys, the TVM keys, and the result here. Notice when you write your result, you write it as a positive, right? This is just for the calculator and the accounting of cash inflows and outflows. You know what action to take. So it's more. This is called a premium bond. When the coupon rate exceeds the yield to maturity. So premium is like you're getting a little bit more. So you'd be willing to pay more for that. Okay, so I just realized for the annuity due, I'm sorry, it just occurred to me in the annuity due formulas, did I do the criteria? I think I did the criteria. I'm going to go back. Sorry, I'm going back here to the annuity due formula. Sorry. For the annuity due formula here. I can't believe it. Oh, it didn't work. All right. So basically, for the annuity due formula, I know I'm backtracking here, but so first, the cash flows were level to the same. They're finite. Here, first cash flow occurs immediately. I need to put that in because I'm going to, I'll share these written up notes as well. So you guys can see the clean notes. You can get the write up notes. And, yeah. If you want to copy that, screenshot. And the formula's here in the box. All right, so in the bond formulas, it's an annuity. For coupon bond, it's the annuity plus the basic time value of money formula. What we're going to do next is use that formula to solve for different variables than just the price. All right, and now you're going to start seeing the real power of the financial calculator. You don't want me to go back to that? I hope you took a screenshot. All right, so let's look at this problem. Rather than finding the price, let's find something else. Now, this is very practical because in secondary markets, you could see that a bond would sell or be available like this, a 3% coupon bond that with a face value of $1,000 in 5 years. It's currently selling at this price. So this is the market price for the bond. So what is the yield? So you want to figure out what the interest or the rate of return is on that bond so you can compare it to other investments. You can say, well, do I want that or I want a higher return for my money? And you try something else. The higher return you go for, the more risky it's going to be inherently, okay? And that's across different securities types of investments. So securities like bonds and stocks. Stocks have a higher required rate of return because they're riskier than debt. Bondholders are more likely to be paid than stockholders, okay, in general. All right, so let's see if we can do this one. So I'll leave it to you to try that. I won't show you the result. And let me know if you get the answer. So let's take 5-minute break. Let's take a 5-minute break. Okay, I'm back. All right, I'm back. So what happened? Nobody wrote anything. Okay, so what is the yield of this bond? Let's enter this into the calculator. The way we do that, keep track of cash flows, right? The signs. This, we want to find out the yield. So we enter, first of all, we write out the formula with the values inside, and we don't know I, so we leave that. Notice you cannot isolate for I. You can try, but it's not going to work. Okay, you can't isolate for I. You can't have I on one side and all the other numbers on the other. You have to do this using a computer or estimation method. And in fact, in undergraduate courses, they teach students how to estimate. And they do that by using tables of annuities and tables of with discount factors. And anyway, this is much easier, okay? It's feasible. I mean, you could do it if you didn't have a calculator, but with the calculator, it's much easier. And as long as you demonstrate that you understand the principle behind what the calculator is doing, I'm happy. So you show me the formula and you enter the values correctly and you get the answer as 6.5%. You have to be careful to be sure to enter the price as a negative because that's what you pay to get these. Those are positive. And what do you get? Well, do you get the 6.5%? Let me know if you got it. Anyone? No comments? No comments. So you got to make this a negative and these ones positive to get 6.5. Well, I'll assume you got it. That a symbol with an OK. Tell. Okay. Louise got it, I guess. All right. Let's try and find another variable. Let's try and find the coupon rate. Now we can do this. You could attempt to solve this analytically. You could isolate for C, but we're not going to. Okay, we're just going to use our calculator. We're going to write out the formula and then use our calculator financial TVM keys to solve. Okay, we're going to go for another half hour for people who are anxious to get to Valentine's celebrations. Today's Valentine's Day. I'm not sure what everyone has planned, but yeah, we're going to go another half hour and then I'll let you go. So in this problem, you want to find the coupon rate, you have the yield, so if this is the market value of $900, the implicit yield is 8%, so that's the yield that you could, anyway, that you're told it has. And what does that mean that the coupon rate is? So usually the only thing that changes in secondary markets would be the price, and then your return would change, right? But otherwise, it's fixed. The coupon rate is determined, so you're just going to find out what it is because it's a predetermined number. No results? You guys just watching me? Well, you'd put it into the formula. You would use your calculator to find that the payment is $54.95. So that's the dollars, but now you need to convert that into a rate. So remembering how we got that, the payment was this coupon rate times the face value. So algebraically, rather than multiplying, I do the opposite. I divide to get the 5.495% coupon rate. And just double checking, multiply this by 1,000 to see you will get this number. So rather than multiply, you're going to divide. So what you can read this week is chapter 4. If you've already read chapter 1, read through, skim through chapter 4, where it talks about all these principles. Great, Alejandro. Valuation of financial assets. Okay, so that'll be a review of what we talked about. I'll go a little more in depth. And I guess that's it for bonds for now. We're going to return to bonds when I talk about the fact that payments or coupon payments are usually made every 6 months. Okay, so because of that, we need, as step 1 rule I told you for valuation, is identify the timing of payments and convert all variables to the same frequency. So if you have if you have biannual, you have payments or coupons every 6 months, then you're going to need the every 6 month interest rate or yield to maturity. So I have to teach you how to do that if you don't know, and we'll get back to that after we discuss one more formula for annuities, and this is known as annuity with growth. And here is a practical example. Angel wants to purchase an annuity. He's going to pay some money into a fund, basically. From that fund, he will receive 30 years of supplemental pension payments beginning next month. These payments will be indexed for inflation. So they anticipate that there will be an inflation of 0.2% per month for the next 30 years. The prevailing interest rate is 0.5% per month, what is the present value of this annuity? So this is what it looks like. This is an annuity with growth. So what did we learn so far? We learned about the perpetuity with growth, and we learned about the annuity, but now we have an annuity with growth. So here's the formula, the timeline. Notice that we still have 1 period. We have to wait 1 period for the first cash flow, and then just like the perpetuity with growth, growth kicks in the second year, and then it's continues. So it accumulates or compounds, but only until the 360th month. And in that year, you have 359 periods of growth because remember, there was a delay in growth, right? It's the second year. Okay, so that's the timeline. How are we going to do this? We need a new formula, right? Because we don't have a formula for this. We are violating the fact that for growing perpetuity, that the payments are not infinite, right? And for growing, and for a annuity, there was no growth in that formula, right? The cash flows were level. So we need a new formula. We violated too many conditions. Here is the new formula, derivation of the new formula. Again, I don't expect you to derive these, but I want to show you where I get them from so they just don't come out of thin air, right? I've actually derived them. So remembering our method. Our method is to take the perpetuity and remove those payments that we don't make. So after the teeth year, the duration of the annuity, we are going to no longer receive any payments. So we have to subtract this amount. So what is this amount? This amount, notice we've kept track of the pattern here. So this would have T periods of growth. Notice that this exponent and this timing are 1 period off, and that's because of the fact that growth was delayed 1 period into the second year. So this, now how do we write this? So this is the growing perpetuity formula. And remember, you have to have the first cash flow on the top. Well, what's the first cash flow? It's not C1, it's this. So this is the first cash flow that grows at 1 plus G. So we take that and we put it over I minus G, because if you remember, that was the growing perpetuity formula. So we're going to subtract this. We first need to discount it T periods, and that's why we have, that's why we have this term. So we take this growing perpetuity, subtract off this discounted perpetuity, and we get this formula when we simplify. Look at that. Now this is not programmed into your calculator. You have to practice entering it. So we're going to take some time to do that to make you comfortable with this. And this formula corresponds to this timeline. So let's down the criteria. Nope, that's not. Okay, so let's put the criteria down for this. So this is cash flows grow at a constant rate G to finite cash flows. 3, the first cash flow 1 period at the end of the first period. And growth happens growth begins in the second. I'll just say in period 2. And I don't write it, but we always assume payments are at the end of the period, okay? Unless I write it down, and I didn't write it down. Okay. Let's look at the condition that I put here. This formula only applies if I does not equal G. What happens if I equals G? If I equals G, this will be 0. And this will be 0. So then you'd have 0 times 0. You'd have 0 divided by 0. That doesn't make any sense. You can't apply this formula. The formula does not work if I equals G. So if I does equal G, you have to use the mixed cash flows approach, okay? If I equals G. Now remember, this is finite, so it's feasible. You can use it. It's not like the case where they're infinite cash flows and you can't use the mixed cash flows or NPV formula. So what I'm going to say here is note red. And I'm going to show you an example. You have to use mixed cash flows to solve because there actually is a solution, okay? Don't forget, there is an answer. All right, so here's the example that I gave you, plugging in the numbers. Okay, let me get the formula. Oh no, it's right here. Okay, here's the formula. So the G is 0.002, 1.002. I is 0.5 or 1.005. You put it here. 360 periods. All right, so what we have to do is simplify this before we begin. And I suggest you start here inside this bracket. Inside this bracket, raise to the power 360, change the sign, add 1. So then you have this whole adjustment factor, and then it's simple enough to multiply by 100 and divide by 0.003. So give that a try, and please let me know if you get the answer. If you want to watch me do it, let me know. All right, did you get it? I do it. So let's see. You could use a scientific calculator if you want, but I'm trying to encourage you all to use the TI VA2 Plus to its fullest. You could just use your other calculators, I guess, the way you're comfortable with. So if I do this, it's 1.002 divided by 1.005 equals to the power of 360 equals, change the sign, add 1. So that's the big bracket. Then I multiply by 100 and divide by 0.003, right? So I multiply by 100 and divide by 0.003. Do I get it? 21, 970, 77. I got it. You can practice that. Now, as you can see, this is very useful because, in fact, getting a supplemental fund to compensate you for rising prices, indexing the pension in a way, or how did I say it here? Yes, so that the purchasing power that you have is not diminished. So this is a big problem with pensioners, seniors on pensions have to worry about having fixed income because it's not compensating them for the rising prices. They're not going to be able to buy the same amount of things they bought in the past. So this is a way to offset that. And I'm going to make some other examples to show you how we can think about inflation and how we work with inflation and these formulas in particular. All right, so you've made no comments. I'm going to assume you're okay. 10 more minutes. All right, so what if I is equal to G? Let's look at a case where that happens. Here you go. So what would you be willing to pay for such a deal? Where you receive $100 in cash flow for 4 months. Starting next month and each month thereafter, the cash flows will grow by 1%. What would you be willing to pay for such a deal if the effective monthly interest rate is 1%? This would be the timeline, but it looks like 1% is the rate and 1% is the growth, the rate of growth as well. So this is what we're looking at. Now, do you see how this simplifies? So the one period of growth cancels with one of these factors down here, right? That leaves that. And then 2 periods of growth offset the 2 periods of discounting here. And then 3 periods of growth offset the 3 periods of discounting here. And these look all the same. So this is actually very easy. The answer will be PV0 equals 4 times 100 over 1.01. Okay, so that's what you would calculate. And in general, you can make a formula if you want, but I prefer that you use first principles to see the pattern, okay? Because it won't be exactly the same problem every time. Very good, Alejandro. So one more problem we'll do in the next 5 minutes. Have a look at it and see if you can try it. So I will post these notes so that you can see. I have finished them pretty much. There's just a few more slides, but we can discuss them next week. So have a look at this. I'll be right back. All right. So how would you approach this? You have an annuity going in, an annuity for deposits to this fund, $3,000 for 30 years at 12%, first payment in 1 year. And then you're going to withdraw from the accumulated amount. So this is very practical. This is like how a pension works, okay? So you're going to withdraw from this fund for the next 20 years. And it's also like an annuity. Annuity is a pension. Pension is an annuity, just like a mortgage is an annuity. Except it goes, this has two sides, right? We're having deposits and withdrawals. I want to find out how big each payment is. The key to solving this is realizing that we want to accumulate the fund and get the future value. And then, and basically, the future value at time 30 from here to here, remember from the very first day I told you, see every single position on the timeline as two perspectives. You have the years before, but then you have the years ahead. So you accumulate to the amount at future value 30, and then you use that as your present value for those future 20 payments. All right, so you call it present value 30. And the way to do that is first calculate using, this is the present value formula for 30 payments at 12%, which is really nice. 12%, it kind of overshoots. On average, investing in the stock market has historically returned 11% a year. Some years less, some years more, but on average, it's 11% over many years. If you look 50 or 80 years, you'll see that. So this is not, I don't know if 50 years is enough to see that 12% on average, we'll assume. But we're going to use 12% and say, okay, so this is the present value, but what I really want is the accumulated amount. So I want the future value. So I need to use the basic time value of money formula. And you'll see it's very easy to ask for FV in your calculator. Instead of PV, you can just get it. And look at that. So it grows to $700,000, so $500,000. So what did we do again? We put $3,000 a month. So if you want to round that off and just not care, just think about simple interest, 3,000 times 12, $36,000 away. Then you can make, there's $36,000 a year if you invested that at 12%, and we're guaranteed that 12%, then you would have $750,000 at the end of 30 years, which you could use to retire with, right? And then how much would you withdraw? Now this amount becomes the present value of the future annuity, or this annuity that's coming to me for 20 periods at the same rate. So we leave the money there. It continues to earn 12%, but you're taking a little bit out each time, and that's captured by this formula. So how large can your payments be? So we put this into our calculator and solve for the payment, and you get, and here are the steps, so you can practice this, about $100,000. Okay, so that's what I want you to practice for next week. I'm going to send you these slides. I'm going to put them in the platform if they're not there, or open them up. I said, I don't remember if I opened it. I'll have to look, and this will all be there for you to work with. So next week, we're going to look at some review problems, but I have them all up. So you review on your own. You're going to look at the questions, you're going to try them, and then you're going to look at the answers, all right? So next week, you come with your questions for me, and I will begin interest rate conversions as soon as I can. So I want to confirm first test. What day did I give you for the first test? So the first test, March 14th, so we still have time. All right, and I said we can get together in person if that works, if we agree. Some people want to meet in person the week before. We can meet in person and we can solve problems in the classroom. I can broadcast. Let me think if I can broadcast in the classroom. Pretty much, as long as I'll have my hotspot. I think I could do it. All right, so that's what we're going to do. And so for next week, chapter 4, review the exercises I post and work on completing all these exercises and bringing questions to me next week, okay? So have a good week. Happy Valentine's Day. Bye for now. I think I crashed.